Good day, class. In today's lecture, we'll be examining the topic of cost. So, cost analysis is part of theory of the firm. Production analysis is also part of theory of the firm, but in today's lecture, the focus will be on cost. Now, moving on to slide 2, which depicts the objectives of today's lecture. Today, we're going to explain and illustrate graphically the short run variation in output, total average, and marginal cost. We'll also look at the relationship between marginal and average cost. We're also going to look at the shape of the short run average cost curve. We're also going to examine how to calculate the short run average cost. In particular, we'll be looking at total cost, marginal cost, fixed cost, variable cost. These are some of the types of costs that we'll be examining in this lecture. On to slide 3. Now we know that production is a process by which inputs are combined, transformed, and turned into outputs. And we know the factors of production would be what? Land, labor, capital, and entrepreneurship. And we know from land, with the cost or income that we receive is rent. From labor, we get wages and salaries. From capital, we get entrepreneurship. From capital, we get interest. And from entrepreneurship, we get profit. So we know there are 4 factors of production: land, labor, capital, entrepreneurship. And from land, we get rent. From labor, we get wages and salaries. From capital, we get interest. And from entrepreneurship, we get profits. Now, moving on to slide 4, we are going to distinguish between the economist's definition of cost versus the accounting definition of cost. So accountants and economists view cost differently. From an accounting perspective, cost involves only the firm's explicit costs. So accountants only examine explicit costs. What is explicit cost? Explicit cost is actual cash payments for inputs or for the factors of production. So the actual amount paid for the factors of production, that is what is called explicit cost. Whereas economic cost involves both implicit cost and explicit costs. And implicit cost is the opportunity cost of inputs that were not purchased. So the opportunity cost, what could I have done with that money if it were used for something else? So economic cost involves explicit and implicit cost. Explicit cost is actual costs and implicit cost is opportunity cost. So the economist cost would be greater than the accounting cost, because accounting cost only takes into consideration explicit cost, which is actual cost, actual cash payments for inputs, whereas the economist takes into consideration implicit cost, which is the opportunity cost, as well as the explicit cost, which is actual cash payments, right? And when we go on to slide 5, we would see a nice example of this, where based on this slide, a matter of fact, the example came before. The example is on slide 6 and the calculation is on slide 5. So it came before. So if we just look at slide 6, we'd see an example where a sole trader in 2000 sold cocoa worth $200,000. Material cost was $60,000. Hiring labor cost was $80,000. Depreciation charges was worth $15,000, other expenses $20,000. Now the building he used could have been used to put to another use, which would have earned $10,000. His capital could have earned interest of $5,000, and his labor as a business manager was worth $25,000. So if we were to distinguish between the accounting profit and the economic profit here, we will see that nicely highlighted in slide 5. So accounting approach, explicit cost, which is actual cost, is $60,000. So he calculated all the actual costs, which is the cost of the raw materials, which would be actual cost, right? And the economic approach, cost here would have been $100,000, which is $60,000 for explicit cost, which is the actual cost. Then the opportunity cost of the entrepreneur's time, which was $30,000, and the opportunity cost of what he could have done with the money, which was another $10,000. Right? So if in slide 7, we would have seen what profits the two would have made. So total sales was $200,000. And cost involved for the accountant was the cost of raw materials, $60,000. the labor 80,000, depreciation 15,000, other expenses 20,000. So his total expenses, or the accountant's total cost, is 175,000. So 200,000, which is his sales minus his total cost, would have left him with a gross profit of $25,000. However, let's take a look at the economist. The economist's sales was 200,000 less the explicit cost, which was the total actual cost, which was 175,000, which left him with 25,000. And he had to subtract all the implicit costs from that, which is the opportunity cost. So the rent foregone, the interest, the salaries, therefore he would have made a gross loss of $15,000. So whereas the accountant would have made a profit of $25,000, the economist would have made a loss of $15,000. That is because the economist included implicit cost, which is the opportunity cost. What could have been done with that money if it were not spent on what it was spent on, right? So the difference between the accountant cost is accountants only include explicit costs, which is actual costs, whereas the economist includes implicit as well as explicit cost, which is the actual cost as well as the opportunity cost. Now we are going to move on to slide 8. And slide 8 is going to distinguish between the short run and the long run. So before we go into the types of costs, we'll just differentiate between the short run and the long run, right? Now, in the short run is a time period for which one factor of production remains fixed. Now, remember the factors of production in this case is labor and capital. So production is a function of labor and capital. So in the short run is the time period for which labor is allowed to vary, but capital is held fixed. And in the long run is a time period for which both factors of production, labor and capital, are allowed to vary. So both labor and capital is allowed to vary in the long run. A firm can decide what size and type of facility to build. So short run, you could only vary your labor, your capital is fixed. Long run, you could vary both your labor and your capital. Now with that said, we are going to move on to examine in slide 9 as well. It would have highlighted exactly what I said about short run and long run. In the short run, certain costs are fixed because the availability of resources is restricted, and a time period that's the short run, and in the long run, all your factors of production are allowed to vary. Now we are going to examine a concept called diminishing returns. The law of diminishing returns. And the law of diminishing returns is a short run phenomenon. It can only happen in the short run. And the law of diminishing returns states that given the present state of technology, there will be a point beyond which the use of further units of variable factor in combination with fixed factors would lead to fall in output per unit of a variable factor. So because in the short run, labor is allowed to vary and capital is held fixed, if you keep adding more labor units to your fixed capital, there's going to come some point called the point of diminishing returns where your output will increase but at a decreasing rate. So for example, if I have one oven and I have two workers working with that one oven and we're baking cakes, if it is I keep increasing the number of workers I have from 3, 2, 3, 4, 5, 6, 7, 8, 9, 10 workers on that one oven, eventually what's going to happen, my output will increase but at a decreasing rate because each worker has to use that same oven. So that is called the law of diminishing returns. As more variable inputs, which is my labor, is added to my fixed input, which is my capital, output will increase but at a decreasing rate. So the principle of diminishing returns states that as variable inputs are added to fixed inputs beyond a certain point, output will increase at a decreasing rate. Now we are going to move on to slide 11, which distinguishes between total costs, which is broken down into fixed costs and variable costs. So in the short run, there are two types of costs, fixed costs and variable costs. What is fixed cost? Fixed cost is a cost which is independent of output produced. So fixed cost is independent of your output. Fixed cost has nothing to do with the amount of goods and services produced. Fixed cost remains constant even as output is increasing. So fixed cost does not vary or it does not increase as total output is increasing. So an example of your fixed cost would be your rent. So let's say you're renting a factory for $10,000. That rent would be an example of fixed cost. Whether or not you produce 1,000 goods or to zero, it does not affect your fixed cost, which is your rent. On the other hand, your variable cost is the cost which is dependent on your output produced. For example, the cost of your raw materials. Your variable cost will increase as your output increase, because if a variable cost is your raw materials, as output increase, the raw materials needed will also increase, and that's going to increase your variable cost. So fixed cost is independent of output, variable cost is dependent on output. Example of fixed cost is rent, example of variable cost is the cost of your raw materials. We will now go on to slide 12, and slide 12 would explain clearly also total cost, average cost, and marginal cost. So total cost, like I said, is a combination of fixed cost and variable cost. It's your labor cost and your capital cost. So total cost is equal to fixed cost plus variable cost. And we know what is fixed cost. Fixed cost is independent of output. Variable cost is dependent on output. Then we have average cost, which is AC. And average cost is your total cost divided by your total quantity or your total output. So average cost is total cost over output. So if it is my total cost of producing chocolates is $100,000 and I had 20 employees produce the chocolates, then my average cost per employee would be what? Sorry, total cost over output. So if it is my total cost is, let's say, $1,000, total cost $1,000, and I produce, let's say, 100 chocolates, then my average cost per chocolate would be what? My $1,000, which is my total cost, divided by the number of chocolates, which is 100, right? Which means my average cost would be 10. So average cost is your total cost divided by your output. And then marginal cost. Marginal is the extra cost of producing one more unit of output. So if I produce one additional unit of chocolate, what is the additional cost? And the formula for marginal cost is change in total cost over change in output. How do we measure change? Change is new minus old. So new minus old. Change in total cost over change in output. Now in slide 13, we are seeing what average cost looks like and what marginal cost looks like. So marginal cost is upward sloping. Average cost is kind of like a U-shaped curve, right? And the average cost curve is always U-shaped, and the marginal cost curve cuts the average cost at its lowest point on the average cost curve. So marginal cuts average at its minimum or at its lowest point. So average cost is a U-shaped curve, marginal cost is kind of upward sloping, marginal cost cuts average cost at its lowest point. So in slide 14, we would see the relationship being explained. When average cost is rising, the marginal cost will always be above the average cost. So if you look at slide 13, when the average cost is increasing, marginal cost is always above average cost. And when average cost is decreasing, marginal cost is below average cost. Marginal cost is what is pulling up the average cost, and marginal cost is what is pulling down the average cost. So that is the relationship between marginal cost and average cost, right? When marginal cost is increasing, when average cost is increasing, marginal cost is above average cost. When average cost is decreasing, marginal cost is below average cost. And marginal cost cuts the average cost at its minimum or at its lowest point.